Hello everybody and welcome to today's video from A-Team Group. Today's video is the UK's new Prudential regime for investment firms. My name is Andrew Delaney. I'm Chief Content Officer at A-Team Group and I will be hosting the discussion on the webinar. So we are going to look at the new IFPR regime that comes into force January 2022, through which the FCA is aiming to streamline and to simplify the prudential requirements for solo regulated investment firms in the UK. For this regulation, firms are going to have to prepare for changes to the way they look at liquidity and capital requirements. They need to put a framework in place to implement the new rules by next January. So it's a major change for UK firms, and I think the message that we're going to hear today is that it might be time to start paying attention to this. So we're going to talk about, just very briefly, we're going to look at the FCA consultation and implementation period. We're going to look at the applicability of the regime and who it does apply to. We're going to discuss something new called K factors. Hopefully we'll be able to give you everything you need to know about these mysterious things. We're going to look at key implementation challenges that you may run into, and finally changes to regulatory reporting that will be required under the new regime. So you're probably thinking, Andrew can't answer all those questions, and you would be right. So I've been joined today by an esteemed panel, as panels often tend to be. We've got a great panel today to help answer those questions. So before we sort of get on with the show, as it were, I'm going to ask the panelists to briefly introduce themselves, starting with Lawrence Blake of Jane Street Financial. Welcome, Lawrence.
Thank you, Andrew. My name's Lawrence. I'm head of risk, as you said, at Jane Street Financial. I've been at Jane Street for about 4.5 years, but I've got a long and varied history in risk management, going back some 20 plus years. My main role at the moment is generally looking after the ICAP, the ILA, recovery and resolution planning, those kind of things. And as part of that, we've obviously got an interest and deep involvement in the new IFPR, and also looking at the IFR in Europe as well, because we have a Dutch entity. So I'm pretty involved going back 2 or 3 years.
Very good. Thank you very much and welcome, as I say. Next up, we have Alan Seabright of Baillie Gifford. Welcome, Alan.
Thank you, Andrew. So I am Alan Seabright. I'm the Deputy Chief Financial Officer at Baillie Gifford, and I am also the Chair of the Investment Association's Working Group on IFR and IFPR. In terms of levels of interest, Baillie Gifford's got 2 UK regulated entities as well as being a regulated group. We've also got an Irish MiFID company as well, so we're looking at both UK and European rules, and also, I am, as I said, chairing the Investment Association Working Group, so I'm interested in how this applies to a whole wide array of firms across the industry. My involvement at Baillie Gifford will be around similar things to Lawrence in terms of involvement in the ICAP, also management of liquidity and managing the team that's responsible for all the reporting, as well as the arriving at capital planning and wind down planning as well. So we've got a little bit of work to do between now and the 1st of January to make sure we're okay on all the new requirements.
Very good. Thank you very much, Alan. Next up, Andrew Lowen of Duff & Phelps. Welcome, Andrew.
Yes, good afternoon, everyone. I've been working with the FCA on secondment and with my clients when I'm not on secondment on this new regime since it first was mooted in 2015. So I work very closely with some of the people that you will be familiar with at the FCA, such as Paul Rich, working very close with him. And I've also been actively involved in writing much of what you've seen through the discussion papers and the consultation papers, the next one due in April, we hope.
Very good. Thank you very much, Andrew. And finally, we welcome Kwame Frimpong of Walters Kluwer. Walters Kluwer is sponsoring this particular webinar. So many thanks for your support, Kwame. Tell us a little bit about yourself, please.
Good afternoon, everyone. My name is Kwame Frimpong, and I'm a product manager in Walters Kluwer. I'm actually responsible for the development and strategy of our IFPR solutions. Now, look to share with you on our thoughts on the key factors going forward. Yeah, thank you.
Great, thank you. Thanks all. Quick couple of points on housekeeping before we proceed. I guess the main thing is that to fill you in on the format, if you are a regular attendee of 18 webinars, you know we basically run a Q&A. We'll have a nice discussion. It'll be a conversation based around a few key points. We're going to intersperse that with a bit of audience interaction. Make sure you're still out there listening and lively and on your toes. So we'll run a couple of polls, and we'll ask people to vote on those polls, and the panel will make their remarks as appropriate. We also encourage questions from Audience. We have Slido to do that. You should have access to the Slido. All Slido questions will come to me. If I think they fit with the discussion, I will introduce them at an appropriate point in that discussion. So please do feel free to ask questions, and I'll try and fit them in. We don't sort of wait till the end. We encourage people just to ask questions, and if I can get them at the right point, that's even better. So, okay, I think that's probably it as far as the housekeeping goes. We're going to kick things off, as I promised, with a poll. So the first poll should be up on Slido, I hope. Let me just check mine, and not seeing it at the moment. Oh, we don't see a Slido. Don't see a poll on here. Okay, the poll is up. So I can't see it on mine for some reason, but that doesn't matter. So let me leave it to you guys. You can. I can't see it in front of me right now, but it's please do vote. Give us an indication of your readiness, and I'm going to ask Alan to kick off the discussion. We'll come back to the poll results after we've talked around the first discussion point. I'm going to ask him to perform the impossible, and that is to predict what this poll result is going to say. No money has changed hands here. Alan, given the divergence between the EU's and the UK's regulations, what is the state of readiness among UK firms for the IFPR deadline of January 2022? And do you think firms are aware of the FCA consultation implementation period, and have they planned accordingly? How does it look from where you sit?
So I'm hoping that my perspective aligns to what the responses are from the audience. I think generally, generally I think the general sense that firms are probably as prepared as they can be. You know, a lot of the IA member firms are aware of the responses that the IA have made to discussion papers and consultation papers, because we've made that available to all members on the microsite and the Investment Association's website. And you know, without final text, firms can't be ready, and I suppose that's the biggest point. We've seen the consultation paper that Andrew alluded to that came out, you know, around the turn of the year, and there's been responses to that, and there is lots of good content in that around classification of firms, solo against consolidated capital adequacy considerations, group capital tests, own funds, some of the key factor stuff that will be discussed in later questions. But that is a consultation paper, and with firms and industry bodies responding, there is potential for change. And also, as Andrew also commented on, We're still waiting for some consultation papers. We're hoping to get one out in April. And some of the fundamental areas that haven't been covered yet are risk to client key factors, governance consideration, remuneration policies, disclosure requirements, and exactly how Pillar 2 will work, including details on liquidity risk and how to go around the wind down, which is now a kind of required part of the Pillar 2 assessment. So I think as we're kind of 9 months away from the effective date and some of these key areas are still not being consulted on, there will need to be some form of transitional arrangements or forbearance given by the regulator, because firms will need to digest these rules. And some areas such as remuneration, they can't expect remuneration policies to be fully compliant on the 1st of January because we'll need to have some alignment with the reward years. So we'll need to have a think about that. And also the ICARA and SREP process, without real clarity on that, firms can't start trying to assess at what level they need to have the risk management frameworks in. So, as I said, given what text is available at the moment, I think firms are reasonably well prepared. I think there are big gaps and there's going to be a lot of work that's going to have to be done in the next 9 months to try and bridge those gaps. In terms of effective dates, again, I think most firms should be aware of the effective date. And hopefully, having read the consultation paper, they'll also be aware that there are some transitional provisions. But again, there will be some areas where we'll need more guidance around transition requirements and what the expectations are of the regulator. In terms of what firms should be looking at now, I would say look at your classification to try and understand whether you're a Class 2 firm or a small and non-interconnected firm. Have a look, if you're a group, at the consolidation against group capital test requirements. It might work for your group. It might be advantageous. Your group might be sufficiently simplistic to allow you to avail yourself of that. And also have a look at own funds. So a lot has been made of the capital requirements. The changes to own funds has been less well trailed, I think, in a lot of the documentation that's come out at the moment. No matter which regime you are coming from, whether you're coming from BIPRU or another legacy regime that's not the CRR, your own funds are likely to change because there are different methods of calculating things like deductions from capital. In the CRR, there's some threshold exemptions. These are not available as we think they're going to be. Sorry, we don't think they're going to be available in the same fashion in the new regime. So I think have a look at own funds, because that could be a source of change in your capital adequacy calculations from the 31st of December this year to the 1st of January when the new regime comes into force.
Very good, thank you. That's a nicely nuanced answer. And I think we'll see how that compares with I think the answers of the poll won't quite fit with that. Pick up those sensitivities. But before we go to the poll, and does that resonate with the rest of the panel? The message I got was, we're doing as well as we can be expected to be, given that there's still a lot of sort of definitional stuff to be done. Expect maybe some forbearance from the regulators when D-Day comes. Is that how the rest of the panel sees it?
It's worth just mentioning that when the Treasury announced that they would be moving the go date from 26th of June, like the rest of Europe, to the 1st of January, it was deliberately called a target date. So I'm expecting, I think most people are expecting it to start on the 1st of January next year, but there's just a chance that it might be put back further because of political agenda, and also that the FCA are struggling to get through 3 consultation papers and a policy statement. As Alan referred to, we don't know the final rules until we see the policy statement. Now that looks very much like the policy statement won't be until late October, early November. So that gives practically no time for firms to understand what the precise rules are. So depending on,
So you have the rules there.
Sorry, excuse me.
For everyone.
Sorry. Sorry, it was my printer decided to start working right next to me, so I had to.
Find the rules and
I pulled the plug out. Don't worry. Sorry about that. Right. Sorry. That's all I had to say on that
very
one.
good.
So
Okay. All right. Well, let's move on, because readiness is what it is. Let's see what the world thinks, as it were. Right. So we're looking at about a third of our respondents are at the project initiation phase, which I think is reasonable, doing a bit of an analysis and design. And some people are out there shopping. Interesting. 10% or so not yet started. Okay, probably this might be a good point to start, as we'll hear going forward with this webinar. Okay, so let's move on to well, let me ask the panel. And does that surprise you at all, folks? Sorry, I didn't give you a chance to respond.
It doesn't surprise me, because I think it came, there's been a lot of discussion. As we said, we haven't had the final rules yet, so some firms may be waiting. But I would urge firms to really get a move on, because as we said, it is actually not that long till the rules come into place. And also, even though we haven't had the final rules have been published in Europe. And although there's no guarantee that the FCA rules will be identical, it's still worth having a look at those rules to get a broad understanding of what, because I think the FCA will be pretty much in line. There may be some deviations here and there, but generally they will be following the European rules. So it's definitely worth looking at the IFR and IFD to get a feel what's likely to come out of the FCA.
I agree with that, Lawrence. I think the FCA was at the table developing the European regime. I wouldn't be at all surprised that if they didn't follow almost line by line the implementing technical standards and the regulatory technical standards that are currently being consulted on by the EBA. There will be some deviation from it. And I think also it's fair to say that bar a few alterations as a consequence of the consultation paper, what you will see as rules are a fairly reliable indication of what they will finally look like as well. So firms can confidently start implementing in line with the draft rules, knowing that the vast majority of it won't change.
Very good, thank you. Okay, so let's move on to the next question, which is really about sort of application of the new rules. I'll throw it to Andrew first, and then we can open it up a bit more. Which types of firm does IFPR apply to, and how well equipped are these firms to deal with this level of regulation?
Okay, very simply, the new MiFID Pro regulatory regime, as it will be called here in the UK, as distinct from IFPR on the continent, will apply completely to MiFID investment firms. And I actually call out specifically exempt CAD firms and local firms, because they've probably got the furthest to go. As Lawrence and Alan have already referred to, some firms are in current regimes that are not too dissimilar as far as own funds are concerned, capital resources are concerned, from where they need to be. But there are certain other firms like exempt CAD firms and local firms that have an awful lot further to go. And the actual impact on exempt CAD firms, for example, will be, instead of being subject to a 50K requirement only, they'll be subject to the fixed overhead requirement. They will need to get their heads around that, despite what the transitional provisions say. And for local firms, they've got even further to go, because they will be subject by definition to the K factors. They can also avail themselves of a transitional, but that's going to see them having to hold considerably more capital. And we're already advising a number of local firms in that quite distressing change over such a short period. We are yet to see how the new regime will apply to collective portfolio management investment firms. These are collective portfolio management firms like UCITS, Mancos, and and alternative investment fund managers that are permitted to undertake additional activities. The FCA or the UK and the FCA have already confirmed that they will be within scope, but we don't know any of the detail around that at the moment. And that's due to be made more clear as part of the second consultation paper. I think it might also be just worth mentioning at this stage that whilst those types of firms will be directly subject to the new regime, a number of other types of firms could be indirectly affected by this new regime, particularly where, as Alan referred to earlier, about prudential consolidation, where you have consolidated situations, as they're now to be called, and either as a result of that consolidated situation, you're including firms that you might not have otherwise included in the past, such as exempt CAD firms. There are certain parts of the BIPRU regime that wouldn't include exempt CAD firms within a prudential consolidation at the moment. And there are other types of firms that are more likely to be part of a prudential a consolidated situation, I should say, as a result. And then, of course, depending on whether you are sufficiently simple as a group and apply for the group capital test, or you are fully within scope of prudential consolidation, it will be that wider group that will be subject indirectly to the new provisions. So you'll find other members of that consolidated situation being subject to provisions that they might not have otherwise been subject to.
Very good, thank you. So Alan, it sounds like some firms have got a long way to go, and it will be challenging for some of these firms. This is something that resonates with you?
Absolutely. I think of all the group companies that I look after at Baillie Gifford, we've got a joint venture that is a CAD exempt for firm, and that's the one that's exercising us the most, because it's gone from a very light touch regime to suddenly being subject to the FOR and the K factor requirements, which will undoubtedly require more capital we put in, because it's got a reasonable amount of AUM. And then also we need to have a think about what we'll need to do from an ICARA perspective, where that was just something that wasn't on the radar of that firm's board at all. So it's ironically the smaller companies that are possibly going to have to make the biggest strides over this short period of time to allow them to comply with the requirements.
So sort of harking back to this awareness theme, I mean, will firms struggle to classify themselves for this regulation, to know what type of firm they are and therefore how they should respond to it?
Hopefully not. I think the differential between a class 3 or a small and non-interconnected firm and a class 2 firm, I think, should be reasonably clear cut. There's AUM measures, there's client money measures, there's other measures. So I think most fundamentally, if you manage more than £1.2 billion worth of AUM for clients, the likelihood is you're going to be a class 2 firm. If you have got any client money that you hold for clients, you're going to be a class 2 firm. So I think
sorry, Alan. Sorry, I didn't mean to cut in. But I think also these firms will. I mean, what actually has helped them is that they've had to address some of these threshold points through the recent FCA survey. They will have had to have understood what some of these terms mean. I think the ones that caused firms the biggest headache was what AUM meant and what client orders handled meant. And I think they're key to whether they're SNI or non-SNI firms. And I think firms are able to make a reasonable stab at it. You'll hear that Alan has already said that he had an exempt CAD firm who's an advisor arranger within his group. And interestingly, he mentioned AUM. Well, ordinarily, you'd expect they wouldn't have any AUM. But of course, advisor arrangers may have ongoing advisory mandates, which is a new concept, which a lot of firms found very difficult to get their head around. And I think we're both, Alan, I, and many others, are waiting for the second consultation paper where, as Alan, I think, also mentioned, that the FCA are due to consult on the risk to client K factors, where they will go into a great deal more detail about what exactly client orders handled and what AUM actually means. So there is a bit of a challenge for them there, but once that's all out in the public, it should be a lot easier.
Very good. We're getting a question from the audience, which has some popularity here. People are voting for it, and that is people are asking, where can we find this FCA consultation? What's the best place to go?
Go on to the FCA website and go into publications and go under consultations. You should find it. I would suggest you read both the discussion paper, which was issued in June last year, which gives you a complete overview of the new regime without setting any policy decisions as far as the FCA are concerned, but it gives you a very good introduction to the new regime and the FCA's thinking around it. And the first consultation paper. So you ought to be looking at DP 20-2, and then also look at the consultation paper, which is CP 20-24. So you can Google that. You should be able to find everything you need by going there.
Great, thank you. And just out of interest, the European rules, are those available through usual channels?
They're on the EBA website.
EBA.
And again, if you Google investment firm regulation, investment firm directive, they'll come up.
Fabulous, great.
And also the EBA's consultations on the regulatory technical standards and the implementing technical standards too.
Yeah, those as well.
Kwame?
Yeah, I mean, as mentioned by Andrew and Alan, so if you access those two websites, you should have access to the EBA regs. Yeah.
Yeah, great. And if you can't find them, then just message us. We'll find those for you. We'll post them somewhere. Post after the event. Okay. So let's move on and I think we're going to go next to a poll. Next poll, we're going to look at here we are. What approach will your firm take for risk to market? Okay, so that's our next poll. It does mention some of these K factors. So we'll come, while you're voting on that, we're going to hear from Lawrence first, I think, then Kwame. Let's talk about these K factors. IFPR and his EU equivalent introduced the concept of K factors. What are they, and what challenges do they pose for practitioners?
Right, so everyone's probably very familiar with the current approach if you're doing capital requirements, market credit, operational risk, and maybe fixed overhead requirement. And essentially the K factors are the new approach for calculating your capital requirements. It's not quite as straightforward as that, because I'll come to that in a minute, but that's really what these K factors are about, how you calculate your capital requirements. Now, if you're a class 3 firm, so if you're small and non-interconnected, then your capital requirement is actually the maximum of your initial capital requirement and your fixed overhead requirement. So you may think you don't need to worry about K factors, but the problem is if the value of certain K factors crosses a certain threshold, then you become a class 2 firm. So you actually will still need to calculate them in case you cross that threshold, because then you will cross into the class 2 firm. If you're a class 2 firm, so you've breached those thresholds, then your capital requirement is the maximum of your initial capital requirement, your fixed overhead requirement, or the K factor. So in terms of the actual K factors, there's quite a few. They're split into 3 categories. And we've probably talked about some already. There's the risk to clients, and there are 4 K factors in there. There's the risk to market, and there's several approaches there. And then there's the risk to firm, and there's 3 approaches in there. And I'll just quickly list them so people are aware. For risk to clients, there's one for assets under management. There's one for client money. There's one for assets safeguarded and administered, and there's one for client orders handled. So that's all the K factors for the risk to clients. And the way they tend to work is that you take a period of time. For example, in client orders handled, you have to look at the previous 6 months and discard the most recent 3 months, and then you take a daily average, and there's a calculation to work out what that notional is and how you calculate it, and then you take a percentage of that. That's your charge. Similar for KAUM, you take an average, 12-month average, and again, there's a percentage requirement of that notional amount which is your capital requirement. And these are generally how the K factors work.
Very good. Thank you very much.
Let me talk about there's two others. Let me just briefly talk about risk to market. There's net position risk, and there's 3 approaches there. And then there's a new one, which is pretty much available currently under CRR. And then there's KCMG, which is clearing margin given. And then finally, risk to firm, you have daily trading flow, trading counterparty default, which is sort of credit risk, and concentration risk, which is similar to large exposure regime in the current CRR.
Excellent. Great. Thank you. Thanks, Horace. Kwame, let's come to you, talk about K factors a little bit. I believe you've got a slide you can share with us here.
Yes, I do. Can I have the slides, please?
All results coming through. Do we have a slide? Should do. There we go. Good.
Yes, thank you. I mean, so there is a lot of talk about K factors. So what exactly are they? So the K factors are risk parameters used in the classification of investment firms and the new calculation method for capital requirements. So they are quantitative indicators that are intended to identify risk that an investment firm may pose to clients, to the markets, and to the firm itself. This is the most significant innovation of the new regime. Investment firms will only need to apply the K factors that are relevant to their business model. The K factors have been divided into 3 main categories, as mentioned by Lauren. So you have risk to client, risk to market, and risk to firm. So risk to client measures are proxies for the business areas of investment firms, from which harm to clients can manifest as problems that will impact the firm's own funds. Within this risk class, 4 K factors have been defined. So you have assets under management, assets safeguarded and administered, client money held, and client orders handled. The second group is risk to market. So these only apply to firms with a trading book that deal on their own account for itself or on behalf of their clients. So there are two K factors under risk to market. So you have net position risk and clearing member guarantee. The final set of K factors belongs to the class referred to as risk to firm. These are also applicable to firms that deal on their own account and are a simplified version of the banking rules for counterparty credit risk and large exposures. So there are 3 risk to firm K factors. So you have trading counterparty default, concentration risk, and daily trading flow. Next slide, please. Right, so I'll now take you through how the K factors are calculated. Investment firms that do not trade on their own book will have to apply the K factors under risk to client. So to calculate the KAUM amount, you have to take the average of recent historical data and multiply by the given coefficient of 2 basis points. So for client money held, you multiply by 45 basis points. Assets safeguarded and administered, 4 basis points. And client orders handled, you have multiply by 10 basis points for cash trades and 1 basis points for derivatives. Again, you are going to have to collect these data as certain data points, work out their averages, and then multiply by the coefficient to derive your K factor requirement. So for firms that deal on own account, you have to calculate the net position risk under risk to market. This follows the standardized approach market risk rules set out under the CRR, which investment firms with trading books will be familiar with, including the revised approaches once they become available. Finally, for risk to firm, you would need to calculate TCD, which is basically based on a simplified approach of the counterparty credit risk in CRR and only applies to derivative transactions. To calculate daily trading flow, you also need to work out the rolling average of recent historical data and multiply by the coefficient. Similar to client orders handled, there is a split between the cash and derivative trades. The final bit is concentration risk, which is identical to the current rules for large exposures under CRR. Relating to the question about the challenges, I do believe that one of the biggest challenges that firms are going to face is around the data requirements and data history for risk decline K factors, specifically in the areas of KAUM, KASA, and KCOH, as firms would need systems and processes to collect, store, and validate large amounts of data that they would not have previously had to do under CRR. This is something that firms will need to look out for. Thank you.
Very good. Thank you, Kwame. So let's now flip to the poll result. If you remember, the question was, what approach will your firm take to risk to market? And the overwhelming winner here is not sure, which, if you take into account that we don't think we're quite ready yet from a definitional standpoint, is probably not that surprising. Gentlemen, is anyone surprised by this? What do we think?
Well, I'm a little surprised because by definition, the alternative standardized approach to KNPR won't be available until 2026. So I'm not exactly sure how firms are thinking of implementing something that doesn't apply to them until then. They, just to make it absolutely clear, the only approach that they can adopt for the first 5 years of the regime is the standardized NPR approach.
They can use an internal model approach if they have the necessary resources and ability. Although I wouldn't think many investment firms under.
We'll put it this way, as far as I'm aware, sorry, things may change. The FCA have no firms that are on internal models, investment firms, solo regulated investment firms that use internal models. I
agree. There's none at the moment, but there's still the option to do it if you really want to put the effort in, right. Which is pretty hard. But yeah.
And will they get the advantage from it?
I think it's quite interesting that I was going to do KCMG, but I don't know the audience or whether there's many proprietary trading firms.
I think maybe they don't deal they don't deal in derivatives, and they're not dealing with central clearers. So,
yeah, I was actually
my only thought
most
on
firms. Oh, sorry,
the proportion of firms that were not sure is actually whether firms are actually caught by this requirement and whether they're sure they're caught by this requirement or not yet. So, if we've got a body of limited license or limited activity asset managers in the audience, then they're unlikely to be caught by this requirement, and therefore they may not have looked at this in any detail. But they may not have even done the work to fully understand whether they're caught by it or not.
True.
Yes, that's true.
True.
Absolutely. Okay. Let's move on. And we're going to come back to Lawrence, and we're going to ask about the teams within regulated firms that are responsible for implementing these new requirements. Are these teams more likely to be regulatory capital teams than compliance? How do you see it?
Actually, I'm going to slightly dodge the question because when you think about it, IFPR is much more than just about capital requirements. We've already heard Alan talk about remuneration. It covers liquidity, reporting, disclosure. There's a whole new Pillar 2 process. So we're going to have a SREP and now an ICARA, which is going to replace the old ICAP. So in fact, it's going to impact quite a lot of different areas within your firms, and I think it could be, and obviously a lot will depend on the size and the business model of the investment firm. There are investment firms which are fairly large. There are some very small investment firms, and then we've got everything from proprietary trading to people who give advice, custodians. So there's a lot of different types of firms as well, and they'll all have different business models. I think the important thing is to make sure that all these different aspects of IFPR are covered by someone in your firm. So whether that's if you have a treasury department or finance department looking at liquidity, whether it's your HR department looking at remuneration, and it could be your compliance or regulatory capital team that's looking at the K factors, for example, you need to make sure that all these aspects are covered. And there's also going to be impacts on governance. So you might have to have a remuneration committee. You might have to have a risk committee. So this is going to go right up to the board level. There's going to be some quite big decisions that need to be made. And some of these things will need quite a long lead time. For example, if you're a firm that needs to have a remuneration committee or a risk committee, you may, we haven't seen the final text yet, but it's possible that you're actually going to need an independent or non-executive director on those committees. And recruiting such people, if you don't have them already, can take a long time. So I think it's important that people are aware that this is not just about capital requirements. It's going to impact all sorts of things within your firm, and you need to think planning about that and get a lot of different departments involved.
Right.
I would agree with that. I mean, from a consultant's perspective, we come across this all the time where a new piece of provision comes into play, and they thrust it on one department like compliance or finance. This is another example of where firms should be looking at it across all departments. I have this constant cry for firms when they're doing their ICAPs at the moment and moving forward to their ICARA process in future, that they need to involve the whole firm in the risk management process, not just simply rely on finance.
Very good. Thank you. We've had a slew of questions from the audience, so I'm going to jump right into those, go off piste, if you will. Let's see if we can address these. Some of them are fairly specific. So first one, AUM will include assets under advice. How are assets under advice to be apportioned? And this is a question because it can make a difference as to whether a UK firm will be SNI or not. Any thoughts on that?
Yeah, the FCA, as you know, produced a survey. Most firms were asked to submit to that survey, and the FCA gave some insight into what the components of AUM ought to be. So it's traditionally, I know this is not answering the question, but just for completeness, it's discretionary investment portfolios where you're undertaking managing investments. That's clearly in scope. But what was new, which I alluded to earlier, was the ongoing advisory. And there's no clear indication yet, and this should actually be much clearer as a consequence of the second consultation paper, what our ongoing advisory actually means. What it is intending to do is to actually capture, remember this is a risk to client metric, that for all intents and purposes, lots of advisory managers simply operate investment advisory portfolios for their clients along pretty much the same lines as discretionary portfolios. The only difference being that they have to go to their clients and ask them each time for their permission each time they want to buy or sell an investment. And so that's the only fundamental difference between discretionary portfolios and advisory portfolios. If the client is relying on that advisor for ongoing suitability and advising them on changes to their portfolio with the opportunity of them saying yes or no, the chances are, and this is the view of the regulator, that because that client has asked the firm to actually advise them, they're hardly in a good position to start challenging them on whether or not they should buy and sell. So they pretty much across the board just say yes to all suggestions. So they believe that this type of portfolio ought to be included in this AUM factor, K factor, for that reason.
Thank you. I'm just going to zip through this. Kwame mentioned new data requirements. What are these, Kwame? What were you referring to when you talked about new data requirements?
I was talking about them sourcing data for decay factors for risk to client. So for instance, as Lauren did mention, so assets under management, be able to get data for 15 months worth of data is going to be quite difficult for clients to get all this data for assets under management, client order handled, client money held. It's actually a large amount of data. So firms need to really prepare for these data requirements, yeah.
And they also need to collect it for the monitoring purpose as well. Sorry, Alan, if you were going to say the same thing, because as Lawrence, I think, made the point earlier, just because you're not subject to the K factors doesn't mean to say you don't have to collect all the data. You need to collect the data in order to be able to determine whether you've broken through one of the small non-interconnected thresholds and become a small non-interconnected firm.
But
Yeah.
also, I just add, it's not just enough to collect the data. You've got to make sure that it's reconciled and audited and all that kind of stuff, because these are going to form part of your regulatory report. So you need to make sure that you've got appropriate governance around how you collect that data, store it, how it's changed if you need to make changes, that kind of thing.
Yeah, the big challenge in that area is that the definition of AUM isn't finalised yet, but if it follows the EBA rules, it's a definition of AUM that very few people will currently collect and calculate. And that could be a big challenge. You know, if you're looking at what they're calling absolute value, which is effectively grossing up your AUM, it'll be hard for firms to necessarily collect that historically. So they may need to then look at the transitional provisions. And also we are finding it possibly difficult to be able to do that absolute value calculation, both at an individual level and at a group level. So it's really important that firms read that next consultation paper when it comes out and understand the definition of AUM, because they will need to get internal stakeholders to help them arrive at that value. And I remember when we went through the work on the AIFMD, when they introduced an absolute value calculation, it was very, very difficult to engage people and allow them to fully understand the very specific nature of that calculation.
Very good. Okay.
I think it's, sorry, just quickly, Andrew, it's worth mentioning, it's already been alluded to, the transitional provisions. Firms won't necessarily have to start collecting this data. Even though we heard for AUM it's 15 months of data, the transitional provisions will expect you to start collecting that data in December this year, if the go date is the 1st of January next year. And there will be provisions within the transitional for short data sets until such time as you've built up enough months for the relevant K-factor data requirements.
Okay. Very good. I'm going to ask the panel to forgive me for the scattergun approach here, but we've got a lot of questions from the audience, which is both encouraging and,
discouraging.
But let's try and get through them as many as we can so we can help people with this. Quick number of points. Question here: will other firms subject to IPRU IMV handbook, for example, category B firms, will they be subject to IFPR?
If I'm understanding the question correctly, if they're they are MiFID exempt or exempt MiFID firms, they're ordinary, they're optional exemption firms, for example, then no, they won't be in scope, because then they do undertake MiFID activities, but they're not, they are exempt for either Article 2 or Article 3 purposes under MiFID, and they will not be in scope, not directly. These are the types of firms that might be in scope if they're part of a consolidation group, though.
Right, okay. Again, another one from the audience. Is the FCA thinking of adding a Pillar 1 requirement based on the activity of its tied agents / appointed representatives?
It is already, sorry, I don't mean to answer all the questions, but appointed reps are within scope indirectly, that if you are a principal and you're subject to the new Prudential regime as a MiFID investment firm, typically an exempt CAD firm, but that doesn't mean to say you can't be a BIPRU firm or an IFPRU firm at the moment and still have appointed reps. You have to calculate your own fixed overhead requirement, taking into account the cost of the appointed rep that you have to meet in order to supervise them as the principal. And you also, if you're subject, so you're a non-SNI firm, and you're subject to the K factors, you have to factor in their regulated activities. So, for example, KAUM and client orders handled, you have to factor what they do into your K factors as well.
Very good. Okay. Let's go back on piste for a while, and if we have time at the end, we'll come back. There's still another bunch of questions, and if you've asked a question, thank you. We will pass these questions on to the panelists, so maybe they can answer post-event. So let's go back to our regular set of questions and ask Lawrence about the key implementation challenges facing compliance teams, or with whichever teams that are involved in this, because it could be a whole array by the sounds of it, as they seek to address these requirements.
Yeah, I'll be fairly brief, I think. I mean, the key thing, first of all, is understanding exactly the regulations and how they apply to your firm. So, you can't do anything until you really understand what the regulations are and how they affect your firm and which bits of the regulation you need to implement. And it may be that, I mean, we've had some issues. We've actually gone to external counsel on a couple of things, not counsel, but external advisors, because there are some bits that are not entirely clear within the regulations, and sometimes you may need to get external advice if you're not certain. So that's one thing to do. The second thing, which I think we've already alluded to, Kwame mentioned, is you're going to need system implementation to calculate some of these K factors. And as Alan said, we haven't necessarily got the exact definitions under, for example, AUM, but you are going to have to have, I imagine, some kind of system implementation to calculate these. You've got to make sure it's auditable, as I mentioned before, that they're accurate, and you've also got to have these things, even though, for example, quite often it says you only have to update them on the first business day of each month, you still got to be able to know every day that you've got sufficient capital. So this isn't just something you can do once a month. You've got to be aware of how these things are changing.
Very good.
And then I think the other thing I want to point out is that the whole focus of risk management is changing under this approach. So currently, it's very much, if you're doing your ICAP, you typically look at your market, credit, and operational risks, and you do some calculations around that. Now, under the ACARA, the focus is harm to customers, harm to markets, and harm to the firm. And so you're going to have to think about, when you're doing your risk and control assessments, you're going to have to think how those categories are impacted. When you're writing your ICARA, that's the focus you have to think about. It's changing the whole way. So I think there is going to be I think that's going to be quite a big implementation challenge, because it's a complete change of approach in terms of how the FCA is thinking you need to manage your risks.
Well, I think to some extent, they've already covered that with their finalised guidance that they issued last June, when they started talking about things in terms of harms. But I also think that when you start thinking about harm to customers, harm to the markets, harm to yourselves as a firm, it starts to make more sense that the harms that you do are aligned with the regulated activities you undertake. And this is the fundamental reason for the new investment firm regime, as opposed to being shoehorned into a regime designed for banks, which principally is looking at things like credit risk, etc.
Okay, thank you. Let's see. Final question, and then we'll see if we've got some possibilities of of audience questions. Let me throw this one at Kwame first. In terms of takeaway, Kwame, what are the main changes to regulatory reporting that IFPR introduces? We've mentioned reporting a little earlier.
Yeah, sure. I mean, the FCA did publish their first consultation paper in December, where it did cover some aspects of the reporting requirements for the new regime. I mean, what you immediately see is that the reporting obligations are much simpler in the UK, although the calculations requirement is consistent with the EU, but the reporting templates are quite different. So the FCA expects firms to be able to produce the detail behind the summarized numbers on demand. Also, all firms, both Class 2 and Class 3, will need to submit their returns on a quarterly basis. The FCA is also proposing to all firms to continue to submit their balance sheet and income statement using the current FSA 29 and FSA 30 forms. The expected first reporting reference date is 31st of March 2022. And as you can see, the returns which firms would need to submit are MIF 001, so which is basically the capital held for fixed overhead requirements and K factor calculations. You have MIF 002 for liquidity, and MIF 003, that would be the monetary metrics on assets under management, client money held, and client orders handled. And MIF 004 and 005 for concentration risk reporting, and MIF 006, that would be for group capital test. So Class 3 firms, which are also known as SNI firms, will not be required to submit reports relating to general concentration risk or the KCON requirements. Regarding the data collection, the FCA is yet to publish the delivery method, and we are quite keen to understand what the delivery format will be when published. Thank you.
Very good.
We're not expecting it to be XBRL.
No,
although
XML, right?
It would be XML, yes.
It'd be XML,
so if you want to report electronically, it'll be XML. It'll go back to the good old days of FSA 001 that you could, or of 003 that you could either fill in online or actually submit electronically using XML.
Okay.
I think just to say, I think for firms who are used to, if-proof firms are used to doing COREP, this is a much less onerous approach. For some firms who are not doing much reporting at all, obviously it's a requirement that they'll have to meet, but it could be much worse if you look at what you're having to do in Europe under IFR.
I do think, Kwame, that some of the European states, I think Luxembourg and Ireland, I think, are sticking with XBRL.
Yeah, that's correct. Yeah.
Very good. Okay, look, we are running out of time, so I'm going to ask each of the panelists to give us 30 seconds of free advice on what people should be doing as they prepare to implement their response, or even think about their response. We've probably touched on most of these, but almost a summary. Let me start with you, Lawrence. I know you're pressed.
I mean, I think the overriding message is that this is happening, and you need to start thinking about it and start, putting plans in action. You can't hang around much longer. The clock is ticking, and obviously different firms will be impacted in different ways. But you need to really have a look at the consultation, the discussion paper, have a look at the European rules as well, to really understand how this is going to impact your firm and really think about what you need to do to enable you to meet the implementation date.
Very good. Alan, what's your counsel?
I think very similar advice in terms of reading the documentation, looking at some of the EBA stuff if there is some holes in or if the CP in the UK hasn't been issued. I think going back to some of the things I said earlier in the call, look at the own funds calculation, understand the own funds calculation, because that could have an impact on your capital adequacy. Kwame's covered the conversation on data collection requirements. Look at that. Look at whether you can get historical figures, because actually the ability to lag and smooth your requirement might mean your requirement's less volatile than if you just have 1 or 2 data points when we start having to assess capital adequacy. If you are a group and you're currently doing your ICAP at a group level, have a think about whether you can practically do your ICARA at a solo level, and whether there's going to be any solo level capital impacts. And then in this year's ICAP, probably start documenting some of the considerations. So think about the assessment of the new regime in terms of Pillar 1 adequacy. Think about your internal assessment. Look at Pillar 2, the likelihood is that any credit risk and market risk floor that the FCA put in place will fall away because there's no Pillar 1 requirement for credit risk and market risk. Think about the wind down, because that's going to be a requirement of the new Pillar 2 regime, as opposed to something that's done and included in the ICAP but doesn't really bite. And then really think about documenting your timeline, both internally and in the ICAP, around what you need to do and by when, and when things will start biting, and or where you're utilising transition provisions. Think about what the steps going through those transitional provisions are.
Very good, thank you. Andrew, free advice.
Yeah, just quickly. I would strongly recommend people, it'd be better to know the devil than not know the devil. So if you're frightened about it, get involved. I know I'm a consultant, and I'm not going to make a sales pitch for consultants. I think you should go and talk to your trade bodies first of all. They've got an awful lot of information that they can have available for you free. Quite frankly, I'd much rather talk to firms that have thought about it before they're actually asking questions. Lawrence has already mentioned that they've reached out to advisors. They've done so on the areas that they need help for. All too often, I have firms coming and seeing me that know practically nothing about it. And of course, then they complain about the cost. So do a lot of your homework, go and speak to your trade bodies, get up to speed with where you need to be, and then only ask the difficult questions to people like me.
Sound advice indeed. Kwame.
Yeah, I'll just keep it simple. So I would just advise firms to review the regulation, understand their categorization and the impact on their capital and liquidity requirements, and also develop an implementation plan. So the most important thing is for firms to invest in their people's processes and systems. Yeah.
Very good. Great. Thank you. All right. So we are basically out of time. A couple of points of housekeeping. First up is we will post the links to the FCA documents that were mentioned earlier. Anything that's pertinent that we can get access to, we'll put those links with the playback of this webinar. So if you want to share it among your colleagues, you'll have some of that reading also attached. We do have an excess of questions, and those questions will be, any we didn't get to, we'll push those out to the panelists. And panelists, if you feel you can address them, that would be great. It'd be very helpful. I think people would really appreciate it.
We can probably come back through you and do that, can't we, rather than direct to the firms?
Yeah. Come through us, and we'll make sure that that gets the right person. I've been asked to draw everyone's attention to some information at the bottom of this page. If you're watching this through the 18 platform, you'll find a couple of mentions of our RegTech Summit Virtual, which is coming up in June, which will be discussing some of the topics we've discussed today. And it also mentions a regulatory data handbook, ditto basically. So feel free to sign up for those. They're largely free of charge. And finally, on Slido, you should see another survey. We're trying to gauge people's appetite for real life events. If anyone remembers what a conference is like, would you like to go to a conference? It will help us with our planning. We'd like to do some, but we really want to see what the marketplace is thinking. So if you take that, that's a great help. If you fill out that quick poll, give us some idea. I know I'm jabbering on, so I will just close by thanking a fantastic panel. Thanks all of you, Alan, Andrew, Kwame, Lawrence. Thanks for sharing. It's been really a very informative session, and I look forward to revisiting this topic soon. So thanks.
No problem. Thank you
all.
Thank you, everyone.
Thank you. Yeah.
Thanks to the audience for joining us. We'll see you on the next one.